trouble because of it. So maybe you could take the time to take a step back and perhaps coach us New Zealanders through what's actually going on, how it happened, and what you think, if some of the fear that's out there is warranted or not.
Sure, I'd be happy to. First, let me say it's great to speak with you again and really appreciate you allowing me to participate here. So maybe I'll just get started at the very highest level. I mean, I think we all know what's been going on from a monetary policy standpoint in the U.S. and other parts of the world for quite a long time. In response to COVID, we had fairly extreme monetary policy measures. We had a whole lot of quantitative easing. We had interest rates drop down to zero or even below zero in certain parts of the world. The effects of that on the banking system, I think we're feeling the after effects right now. One of the effects was quantitative easing, which is essentially central banks out there buying up a lot of assets. Well, as they're purchasing those assets, it also serves to bolster banks' balance sheets. A flood of deposits came onto banks' balance sheets as a result of quantitative easing, which normally you'd think, well, that's quite a good thing for banks. But simultaneously, they're taking interest rates down to zero, which gave banks very few opportunities to invest those deposits they're receiving with any type of a return. And so one of the exercises that some banks went through was to go out and take on a little bit more risk to get a little bit more return with that big wave of deposits they had. Not a lot of credit risk. It wasn't as if they were out making a bunch of bad loans or investing in a bunch of dodgy securities. Generally, they invested those in very high quality securities, but they did take on some duration risk. They went out and they bought longer dated securities to get a little bit more yield as more of a profit-making endeavor. And that actually worked out just fine for a while. But as the Fed started to hike interest rates, that's when banks really started to run into some problems here. Now, let me maybe take a step back and say, generally speaking, the banking system in the U.S. is in extremely good shape. In fact, I think you could argue by a lot of measures, whether it's still a lot of deposits in the banking system, not spread out evenly, but still a massive amount of deposits, lots of capital. Tier 1 capital ratios for banks are as high as they've ever been. Non-performing loans are extremely low. It's not a system-wide banking crisis that we're experiencing right now. We're experiencing a crisis within select smaller regional banks. And then I think underlying all of that for those banks is more of a crisis of confidence, because banks, as much as anything else, rely on confidence to stay in business. Depositors want to know that their deposits are safe. Anyone doing business with the bank wants it to be a stable institution. And if they get any inclination that it's not, well, you can get a run on deposits or a run of customers. And of course, that's not good for a bank, as we're seeing here recently. So with that as a backdrop, and going back to what I said before about monetary policy, interest rates, and so forth, you had a number of banks that were very successful bringing the deposits. Silicon Valley Bank, one of the first banks to fail here, was a prime example of that. But as they're taking on more and more duration risk and interest rates are rising, that duration risk starts to work against them. So the bonds that they had purchased, even though they're very high quality bonds, risk of defaulting, the value of those bonds is declining. Because interest rates are moving higher, and we all know the way bonds work is that when interest rates go up, prices go down. And so because the Fed is so aggressively hiking interest rates, the value of the securities they invested in starts to go down. Now, that by itself isn't terribly problematic for U.S. banks, because the way our accounting systems work is banks can hold securities like that in different ways. They can put it in a bucket that's called available to sell, which means there's a chance they might sell those securities. And when they're in that particular bucket, they have to mark them to market. And so as interest rates are going up and prices are coming down, that's being realized by banks, at least from a capital standpoint, in real time. But there's another bucket that banks can put those securities into called held to maturity securities. Those don't have to be marked to market. That's basically the bank saying, we have no intention of selling these anytime soon. They can sell them, but then they have to move them out of that bucket. But it's basically them saying, we don't want to mark these to market because we're not intending to sell them anyway. And if they're just going to stay there, there's no reason that modest fluctuations, a little bit of volatility in their prices should be affecting bank earnings and capital ratios and so forth. And so they can stow those securities in that particular bucket. And so when I say that the prices of these securities going down isn't by itself terribly negative, because as long as those securities are in that held to maturity bucket, they don't really affect the bank in meaningful ways. Well, all that's fine and good, but then you take an institution like Silicon Valley Bank. Now, Silicon Valley Bank was a very unique institution. It's California-based bank, as the name implies. It was located in Silicon Valley up here in Northern California, where I am right now. Also, as the name implies, it did a lot of business with Silicon Valley-oriented companies. A lot of venture capitalists, the companies that venture capitalists would be investing in, biotech-type companies. It was steeped in that community of VC and VC-funded companies. And for a while, that was a tremendous thing, because you go back to 2020, you go back to 2021, when those industries are booming, that means deposits are coming in like crazy. Not only are they benefiting from an influx of deposits tied to things like quantitative easing, but as venture capitalists are raising lots of money, as the companies that they're supporting are receiving that money, they're all opening accounts at an institution like Silicon Valley Bank. And so their deposit bank is going up even more aggressively than others. And so that just puts a further burden on them to figure out something to do with those deposits. Well, what it also means, though, is that they've got a high concentration of a certain type of customer. And that's really where Silicon Valley Bank ran afoul. They started, as they're getting that influx of deposits, that's all fine and good when deposits are coming in, but then you get into 2022. Not only are interest rates going up and so the value of their securities is going down, the VC industry starts to run into some trouble as well. Money is just not coming in like it was previously. And so what had been an inflow of money to the banks or the companies that Silicon Valley Bank is doing business with, that starts to turn into outflows. So instead of money coming in the door, money starts going out the door. And you combine that with higher interest rates and then quantitative tightening, which is also shrinking deposits. All of that leads to problems for Silicon Valley Bank. The kind of timeline for their demise was that they recognized that they probably needed more money, they needed more capital, they didn't want to have to sell some of their securities in order to meet some of these outflow of deposits, so they went and tried to raise capital. I believe it was Goldman Sachs that they hired to go out and raise some money for them, but they failed to do it. And that started to spark a lot of worry, because depositors and investors said, well, if they can't go out and raise capital and they're seeming like they need it, maybe the bank is in trouble. And this goes back to that confidence issue that I mentioned before. Banks exist because they have the confidence of their customers and their depositors, and when that confidence starts to go away, you get a crisis of confidence. And that's essentially what happened to Silicon Valley Bank. Unfortunately for the management, they had also mismanaged their balance sheet. There was a big mismatch in terms of the duration of the assets they'd invested in. As I mentioned, they really went kind of far out on the duration scale to try and get a little bit of return, which led to bigger losses in their securities books and so forth. And so it was sort of a perfect storm of them being focused on a particular type of customer that was struggling, having taken on too much duration risk in their assets, seeing an outflow of deposits, and finally, that led to the insolvency of Silicon Valley Bank. And so as those deposits are flying out the door, they have to turn to that held to maturity book. There are lots of losses embedded in there. That erodes the bank capital, and next thing you know, they're in receivership. So then investors start saying, well, who's the next bank that might be in trouble? That turns us to an institution like First Republic Bank. First Republic, also a Northern California-based bank. It's based out of San Francisco, but shares a lot of the characteristics that Silicon Valley Bank had. Also caters to kind of big, high net worth customers in Northern California. A lot of them also involved in the technology industry or the biotech industry and those types of things. And so to the extent you had a deposit flight coming out of Silicon Valley Bank, folks started to worry that the same thing might start happening to First Republic Bank. Sure enough, you do start to see a flight of deposits, they run into the same issue and so forth. And so I think what you're seeing now is the market turning on some of these banks and saying, where is the next most vulnerable bank that can lead to panic? You've seen some response to all of this from the Federal Reserve, of course, in terms of some of the new lending facilities they put in place. We can talk about that in a moment, but it hasn't been enough to stem these deposits from select institutions. So it's all a very long way of saying it's not a system-wide problem that we're seeing right now. It's a problem with select institutions that either mismanaged their balance sheet, had too much customer concentration. Now they're experiencing some deposit flight that's getting them into trouble. But generally speaking, the financial system is still in very sound shape. Banks are by and large able to lend. In fact, even for regional banks, of course, not the ones that have run into a lot of trouble here, those specific ones, but across regional banks, recent results have actually been pretty good. Deposits haven't been flying out the door. Lending has remained fairly robust. Big money center banks that are, of course, responsible for a big part of U.S. banking are in extremely good shape. In fact, if anything, they're some of the beneficiaries of what's going on right now, because as people might be leaving some of these regional banks, they're moving to some of the money center banks because they're deemed as being safer and so forth. And so I think what we're seeing now is more of a shifting around within the banking system versus some big systemic problem that's going to lead to any type of financial crisis.
Aaron, it's a great summary. I think the way that we can sort of look at this is that as investors, we always think about diversification. Some of these banks just didn't diversify their customer base. And so one issue within a sector like the tech sector, and it's not that these banks had the tech sector shares as security or anything, but the tech sector needed their money back to pay for their employees or what have you, because they weren't getting money in on the other side from investors as the market went into a bit of a freeze in 2022. And so if all your clients are doing that, redeeming their deposits to use for their business as usual activities, it's going to be a problem if all your customers are in the tech sector, isn't it? And so it seems pretty obvious now, and I think, obviously it's hindsight's always a wonderful thing, but it seems pretty obvious that you'd want to diversify the depositor base, like some of these big banks that are benefiting from it, like you say, like the JP Morgans and those sorts of banks on the bigger scale.
Yeah, that's exactly right. I mean, in some ways, the nature of regional banking is more concentrated. I mean, most regional banks focus on a specific geography. Like I said, Silicon Valley Bank, First Republic, very Northern California focused. They were branching out to other areas like New York and so forth, but the nature of a regional bank tends to be either geographically focused in terms of their customer base, or they cater to a specific industry, maybe not as focused as, say, Silicon Valley Bank was, but there might be a particular industry they cater to, a Texas bank focusing on the energy industry, or a Boston bank focusing on biotech, or whatever it might be. There does tend to be a higher level of concentration here. And I think what we're learning today is, to the extent all of the folks in that industry move in one direction or another, that can pose some real risks to banks. I mean, Silicon Valley Bank was a big beneficiary of that to the plus side. As those industries are booming, they're doing phenomenally well. But when things go the opposite direction here, I think we see some of the risks.
What do you see the outcome for regional banks? Because at the moment, we've got regional banks still under the spotlight, still getting into trouble and losing deposits, even though the Fed has come out and said, there will be, like you said, perhaps it wasn't enough of a support, but there is support around those regional banks now if they become in trouble. And so as a depositor, it feels like you're in a pretty safe hands, even if you are in a regional bank, yet that doesn't seem to be working. And the second point is, and this some of these questions come from the fact that in New Zealand we have 4 banks that are Aussie-owned. There's a couple of small ones, but really you have no choice. We do have one sort of quasi-government-owned bank, but really we've got 4 big banks who are, for better or worse, there's articles out this morning in the newspaper talking about the profits they make on New Zealand customers versus their Aussie counterparts. But that's a different story. But in a regional bank, were they allowed to grow, and have they been allowed to grow so much because regulation is different from the bigger banks? And so is it just a lack of regulation on a regional bank versus some of the big ones? Because the big ones are obviously, quote unquote, too big to fail. But why were the regulations a bit more lax on the regionals? And is this why we are having the problems in the first place?
Well, just as a point of comparison to what you said there, 4 banks in New Zealand, we've got over 4,000 banks here in the U.S., so quite a few more, and that's down from 14,000 decades ago. So already there's been a lot of consolidation. We've gone from 14,000 to 4,000, but still a lot of banks out there. And I think this does pose some challenges to the regional banking model. I mean, I think, what you saw as some of these banks were really running into trouble was that, of course, we've got our FDIC limits, and so, U.S. deposits are insured up to $250,000 per account holder. And so there are ways to get more deposit insurance, but there are limits to how much you can get there. One of the other problems that some of these institutions had was they had high amounts of uninsured deposits, meaning that if you were a company doing business with the Silicon Valley Bank or some of the others, your deposit base probably greatly exceeded your insurance limits. And so that's when people really start to get worried. The first insured amount, they say, well, I'm not so worried about that. If my bank goes under, that's insured. I'm going to get that money back anyway. It's the excess deposits that people get really worried about. And so going back to the regional versus money center bank question, I think one of the reasons that money center banks have been a big beneficiary here is because, one, they are deemed as being more safe. They're just much larger. They're more diversified in terms of their customer base. They do business all throughout the world, mostly in the U.S., but all throughout the world, really. They've got, investment banking businesses. They've got asset management businesses. They're just big, well-diversified institutions where the risks, at least today, are a lot lower. And so I think what a lot of depositors at an institution like a First Republic or a Silicon Valley Bank learned is that, boy, if I'm worried about my uninsured deposits and I need to get them out of there very quickly, which, in itself is a little bit of a problem as well, because the pace at which you can get deposits out is so much faster today than it has been historically. Back in prior bank runs during, say, the savings and loan crisis in, decades ago, if you wanted to get your money out, it was difficult. You probably had to go to the branch and fill out paperwork and do all those things. Today, you just get on your phone and you transfer money, so long as you've got accounts elsewhere. And the folks that I think were really panicked were the ones that maybe only did business with Silicon Valley Bank or First Republic and didn't have accounts set up elsewhere. And there was a mad scramble to get an account set up at a big money center bank so you could transfer money if you wanted to, and those types of things. And so I think that those types of issues, just the perceived safety of the bigger banks, and worried about the deposits at the regional banks, of course, was part of the problem. But I don't think that that is just a function of regulation. There are different regulations applied to different banks, of course. The big money center banks have got specific regulations on a number of different things. The leverage ratios they have to comply with, capital requirements, and so forth, because they're deemed to be more systemically important. The idea being that if a big money center bank like a JP Morgan or a Bank of America or a Citigroup goes under, well, that could lead to systemic financial system problems. Whereas if a smaller regional bank goes under, even as we're seeing today, the risks just aren't as great for the overall financial system. So there are added regulations that apply to bigger banks versus smaller banks, but I don't think that that was the main cause of the problem here. I think what you're seeing here is that with changes in interest rates, with changes in monetary policy, that's just led to some disruptions that are affecting certain banks more than others. And now that the tide is going out, you're finding out who's swimming naked, so to speak. But I don't think it is a regulatory issue. I think there are problems with some banks, as you said, being over-concentrated in the customer bases. Some didn't manage their portfolio risks all that well. But I think there is just also some momentum behind this lack of confidence that we're seeing right now. And, banks are very different than other institutions. If a bank price falls 70, 80% and its bonds plummet and its, its default insurance goes up a lot, well, that can be a self-fulfilling prophecy for a bank. That can lead to a bank going under because it is all about confidence for banks. Whereas for another institution, if you're a manufacturer, you're a technology company, other types of companies, people might lose confidence in you, but you can just keep on doing business throughout that period, hopefully regain their confidence, and you're fine. But for a bank, the scenario is very different. That lack of confidence can be extremely detrimental to a bank, and it leave them into receivership like we're seeing right now, which is just a very different environment for other types of institutions. But I don't think it was just about regulation. I think inevitably you will see some increasing regulation tied to all of this. I mean, regulators never let a banking crisis go by without taking advantage of the opportunity to add more regulation. I'd say it's not entirely clear what that is going to be at this point, but certainly regulators don't want to see the regional banking system collapse. And so I expect, you've already seen some measures, as you mentioned, to try and shore up the system as best they can. It hasn't been all that effective. You continue to see banks running into problems. I expect you'll see more FDIC insurance or more regulations put in place to kind of correct for some of the problems that we're seeing today.
So how do you see it playing out? And you mentioned an interesting stat, sort of 14,000 banks. That was probably before the savings and loans debacle, now consolidated down to 4,000. Do you see that consolidating again because of this? And one aspect of the crisis, which is interesting, it's somewhat related, but kind of not related, but they were all related when it comes to interest rates, I guess, is the commercial property market is also another sector that's perhaps a bit in trouble in some parts of the US, and the biggest lenders or not the biggest, a big lender to the commercial real estate market is regional banks. So do you see this as another period of consolidation? I guess when you think behaviorally, if I was sitting there with a whole lot of cash sitting in the bank, which as an equity investor, you'll hope that I don't have that and it's sitting in stocks. But if I did, and if you were in a regional bank, you probably would be thinking, look, I'm going to think about move it to a bigger bank because it just feels better, even though that might be not the rational thing to do at that point in time. But are we going to see a big sector change? And the second part to that question, as a fellow equity investor, or what's the opportunity? Are you seeing it from an investor in shares? Are there some really interesting things that you can put in the portfolio to one, I guess, protect the portfolio from some of the ructions of this, but also with every cloud there's a silver lining, and are there some opportunities for deploying capital in some parts of the sector that looks like they'll benefit, even though never want to sort of crush the people that are involved, that are doing it tough, but when you look out for your clients, what are you seeing out there?
Yeah, well, first off, there is a reason that regional banks exist. I mean, people like doing business with regional banks, and I think they serve a very important purpose. There are certain types of lending, as you mentioned, that they are much more prominent in, like commercial real estate. And so it might sound odd to have that many banks, but there's a legitimate reason that people want to do business with regional banks versus big money banks and so forth. Excuse me for one moment. Sorry about that.
Bring them on screen.
Yeah. So I don't think regional banks are going away by any means. I wouldn't expect a massive amount of consolidation, especially considering, going back to the regulatory comment, one of the regulations that is applied to money center banks is, especially for the biggest ones, there's a limit to how much they can grow. Not organically, they can keep growing organically, but they can't grow by acquisition. So once you reach 10% of U.S. deposits, you can't acquire banks anymore. Now, there are exceptions. You saw that J.P. Morgan purchased most of First Republic.
Yep.
And so in a crisis situation like that, you can override that rule. But there's not a lot of room for consolidation outside of these types of crisis scenarios, at least amongst the money center banks. Now, there's kind of the next tier of banks that still have room to grow. But I think in an environment like this, when it seems exactly to your point, like, boy, this seems extremely attractive, why wouldn't you want to go in and buy some of these banks that are now trading below book value? It seems like an opportune time to do that. Maybe they don't have a lot of other options and would mind being acquired, even despite the very depressed equity prices and so forth. But I think an environment like this has everybody feeling very cautious. And even kind of mid-sized, very healthy banks, they want to be mindful of what they're doing with their capital and some of the disruption that can be caused by acquisitions and so forth. And so I don't expect that this is going to lead to a big near-term wave of consolidation, although there probably is some opportunity for that. I think maybe the offsetting feature there is that clearly some scale is important. A little bit more diversification if you can pair up, merge with other regional banks, even if you're not being purchased by the big ones. Having a little bit more customer base diversification, having a little bit more geographic diversification certainly seems like a good thing today. And so I think from a risk management standpoint, there's a case to be made for some more consolidation. In terms of, but I think that'll probably take some time, and I wouldn't expect it to be, a massive shrinking of that 4,000 banks down to half as much, but probably there is some opportunity there. In terms of other risks that this might pose in terms of overall lending and specific lending to areas like commercial real estate, as you mentioned, I do think that certainly can be affected at least a little bit. As I mentioned before, so far, banks have seemed pretty willing to lend. I mean, if you look at where the problems have been, I think one way to measure that is by looking at regional banks' balance sheets. And so when a regional bank or any type of commercial bank runs into trouble and they need to borrow from the Fed, they do that through their local regional banks. And so you can look at which regional banks have seen increases in their lending to get a sense of, which geographically where these banks are running into trouble. And surprise, surprise, what you're seeing recently is there has been a lot of lending through the discount window through some of the Fed's new facilities. Not as much as people thought there might be initially, but it's very focused in a couple of geographies. San Francisco, of course, tied to some of these California-based banks running into problems. New York has seen a spike up with companies like Signature Bank, which also was one of the first banks to go under. Outside of that, there has not been a big uptake in some of these emergency facilities that you're seeing here. And so it's been very regionalized in that sense. It's not broad-based banks running into trouble. And so outside of those specific areas, results have actually been pretty good. Net interest margins may be feeling a little bit of pressure. The deposits may be flowing out very slightly, but not in some extreme way, but overall lending rates holding up fairly well. So I would expect that this is a little bit depressive to overall lending. Fortunately, loan growth coming into this period was extremely strong. And loan growth was running at a double-digit pace in the U.S. prior to this crisis. And so while it probably leads to some deceleration, I don't think it takes us into some big lockup in credit conditions here. Now, for those specific industries that you mentioned, like commercial real estate, there it's almost a 1-2 punch. Not only are they more reliant on regional banks, and so to the extent regional banks pull back a little bit more than others, that probably does have an effect on commercial real estate. It's also true that commercial real estate just hasn't been doing particularly well here in the U.S. I mean, the hardest hit parts of commercial real estate have been office lending and retail rent lending. I mean, in the wake of COVID, with a lot of people working from home, vacancy rates are up in office buildings, as we all know, and that's weighed on prices for commercial buildings.
There was an article in Bloomberg that got to New Zealand around a commercial property. I think it was in San Francisco, I think it was, where it was valued at $300 million, and it's been empty for a while because of working from home, and now they're trying to get $60 million for it, and it's pretty big, substantial building and a pretty decent address. It's always good to take the worst case scenario, and I'm sure there's other reasons why this particular building is sort of valued at 60 cents, or I can't even do that math, 20 cents to the dollar, but that's not really a banking crisis problem. That's a whole sort of societal change, especially in California, around people not going to the office anymore.
Yeah, that's right. In fact, that particular building that you mentioned really hits home for me. My first job in finance was working in San Francisco, just a couple blocks away from that building in downtown San Francisco. So I know it very well. It was always kind of like the most prominent, financial center building in California Street where we worked, and now it's having all the problems that you mentioned there. But and that's true in other parts of the country as well. Although, as often happens in media, this is kind of the worst case scenario that we've seen, and it's one building, and it is hundreds of millions of dollars. But most parts of commercial real estate aren't in that type of shape. I mean, most commercial real estate generally is multifamily housing. It's not office REITs, or it's not office space. It's not retail. If you take, from a mortgage standpoint, the entire commercial real estate market, it comprises about a quarter of the overall U.S. mortgage market. Then you take the real problematic parts of that, which would be office buildings, absolutely. Also would be strip malls. It would be other retail space. Those have been kind of the worst performing parts of the commercial real estate market. They're even a small subset of that 25% slice. And so it's all a long way of saying, yes, there are problems in commercial real estate. Those problems could be somewhat exacerbated by the fact that they're more reliant on regional banks for lending that could be pulling back. But I don't look at this as being some big economy-wide problem that we're entering into here. I don't think that you're suddenly going to see a wave of defaults in commercial real estates that leads to a banking crisis and so forth. But, I also wouldn't necessarily be jumping in with both feet and looking for opportunities there. I think we're still in a transition phase where people are figuring out what the work from home versus in-office environment is going to look like going forward. You asked about investable opportunities. I would say the same thing about regional banks today. I mean, I do think we're entering the phase of this crisis, if that's what we want to call it, where the baby's being thrown out with the bathwater a bit. I mean, even some of the banks that have gone under, First Republic was a very good bank, but when people lose faith in it, they lose faith in it. Even Silicon Valley Bank, despite its concentrations and so forth, and despite some of the problems it had managing its balance sheet, it was otherwise a very sound institution. It's not like these are banks that have gone out and made tons of bad loans or invested in a bunch of very
this isn't 2008, is it?
Exactly, yeah. So, there are lots of good institutions out there, and I think now you're seeing, as I mentioned, the baby being thrown out with the bathwater, which normally you might say, well, that's an opportunity, buy some of these really depressed values in banks today, and in the long run that'll pay out. But as I mentioned before, it's very different for banks than other institutions. You can be looking at a bank that looks like a screaming deal, and if they start to get a run on the bank and so forth, just the fact that its equity price is so depressed or its bond price is so depressed can actually force it to go under, versus other types of businesses where you figure you buy at a depressed level, maybe that's a long-term opportunity. It's not quite as clear that that's the case in regional banks today. But I do think we're entering the point now where some of these fears have gotten to be excessive. I mean, what you're seeing is that California banks, as I mentioned, are being hit harder than other banks. It's not as if the California economy is in so much worse shape than the rest of the country. In fact, compared to a lot of other states, it's in perfectly fine shape, very good shape. And so I think some of the factors that seem to be coinciding with the worst performing share prices and so forth, I don't know that those are necessarily warranted. I think we're entering into sort of a panic stage, which could present some forward-looking opportunities, but also a lot of idiosyncratic risk. Again, here, I wouldn't necessarily be jumping with both feet to regional banks right now. I think this all needs to sort itself out a little bit.
Yeah, it's fascinating, Banks. That's exactly what you said earlier when you said it's not like it's a manufacturing company. In the end, it's about confidence with these banks, and they could be the best institution out there. But if people lack confidence and start redeeming, the bank's in trouble. No matter how great the management team is, no matter how great their tier 1 capital ratios are, they don't really have a choice. And banking is confidence.
Exactly right.
So Aaron, this is a good way to sort of ease into the sort of more general economic conditions with this question that I wanted to discuss with you. And you're going to say, well, it doesn't matter, because that's which was a really, I thought, a great point in one of the articles that you recently published after the Fed hiked this week in the first week of May. But bear with me to ask the question, because it is topical, and it's around the Fed and interest rate hiking, because whether we like it or not, being in New Zealand, whatever the Fed does is kind of going to sort of, I guess, give the thematic of what happens in most developed countries, whether it be New Zealand, Australia, or Europe. And with the Fed hiking this week, but also, I guess, indicating a pause. And perhaps the pause is coming from the fact that they, are thinking about this banking crisis and the tighter lending standards is the equivalent of raising interest rates. And without getting you to answer that question, because I think there's enough pointy-head governors out there that can talk about it, is this getting us more likely to head into some sort of recession? And how do you think, let's start at the broader economy, how do you think things are going out there in the US with fighting inflation, but also what's going on in the broader economy around economic growth, and how are you reading things? And there's a lot of negativity out there and people sitting on the sidelines. But you made a really good point in one of the papers I keep referring to all these papers. I've been sick the last few days. You guys present one every day. It is absolutely impressive. And when you're sick in bed for a few days, you actually have a lot of time just to read stuff. And so I've read a lot of Fisher investment thoughts coming into talking with you. So it looks like I've done a lot of research, which I have. But it's been a great few days of reading. But one thing I think I was listening to Ken Fisher, your founder, saying is that actually since October, stocks are up 17%. And so, you can talk about the negativity of what's going on, but actually it's despite interest rates going up since October, it's actually been a pretty darn good environment for shares. And we need to just take a step back and go, things aren't that bad. But what are things like out there? How do you see things going forward?
Yeah, well, I think that's a great point you made there at the end. And just to add on to that, not only are stocks up 17% since October, if you measure global equities from where they were when the Fed started hiking rates, in early last year, first quarter of last year, they're actually flat to up slightly from then even. And so this whole notion of don't fight the Fed doesn't really hold water. Historically, if you look at how equities have done after the Fed starts hiking rates, more often than not, they're positive. On average, they're up. Even in this cycle, They're up since the Fed started hiking interest rates, which maybe gets back to a key point we've always made about the Fed. We kind of jokingly say the Fed doesn't matter. Isn't the Fed doesn't matter? It's just not as if in 1913, when the Fed was created, we created this magic institution that can dictate where equity markets go or other capital markets go or how the economy does. I mean, the Fed is a very important institution, but it's not the only thing that drives economic growth by any means. In fact, I think in some ways you could say it does the opposite at times. It's not the only thing that drives equities higher or lower. And yet today, when we say it doesn't matter, really I would say relative to the importance that some people seem to put on Fed policy, we would say the Fed is relevant. It's just not the only thing that matters. And yet if you listen to lots of forecasters today, lots of economists, you might get the impression that all that matters is whether the Fed is hiking or cutting. We would simply say, take whatever importance you think the Fed and interest rates and monetary policy have for the economy and for capital markets and cut that down by at least 50% and then see how you feel about things. And exactly to your point, I think that this recent period has been a great example of that. I mean, the Fed has hiked interest rates at a historically very aggressive pace. And that's leading to some problems, as I mentioned. A lot of the financial system problems we're seeing today, I would say, do tie very closely back to these dramatic changes in monetary policy, which I think is a good reason why some of them probably never should have been used in the first place. But overall, the economy is actually weathering this period very well. Recent labor market data shows the labor markets are very strong. You look at most parts of the economy, they're actually doing very well. I mean, what we've said throughout this entire period is that it's very likely the U.S. and even the global economy weather this period a lot better than folks were fearing. I mean, if we do ultimately get a recession, which we haven't seen one yet by any means, and that's not to say we couldn't get one, but if we get one, it's going to be the most widely anticipated recession we've ever seen. I mean, by just about any measure, recession expectations are off the charts. And I think that has some important implications. It's got implications for equities, our realm of endeavor, because we view global equities as being efficient. And when people expect a recession, that expectation gets baked into equity pricing. And so there's just not a lot of surprise power left to it. And so unless we get some form of an economic downturn or recession that's much worse than is already anticipated, there's just not a lot of surprise power to a recession anymore. I also think it has implications for how things like corporations operate. I mean, you read a lot these days about layoffs or slowing down hiring or companies, trying to bolster up their balance sheets and so forth. I think all of that is companies preparing for these widespread recession fears. And I think the implication of that is that usually recessions are more surprising. Usually everybody doesn't know they're coming. And I don't mean to say that we're necessarily going to have one, but if we get one, everybody seems to have known this recession is coming. When it's a surprise, though, that means companies are scrambling to do that in real time as the recession is going on. And that just makes it worse. When you have to lay off a lot of employees in short order or rein in your balance sheet or do all the things that companies do during a recession, and you're trying to do that very quickly in kind of a scramble mode, well, that just makes the recession worse. Here, what we're seeing is we're certainly not in recession yet, and yet companies have already gone a long way to preparing themselves for a recession if we get one. And I think what that means is that if we get a recession, it probably is a pretty mild one because a lot of that work has been done ahead of time. And so what we're seeing in the economy is things seem to be still in quite good shape. I mean, you look at overall economic activity, just look at the recent GDP reports. They're not lighting the world on fire, but they're certainly not recessionary. They look fairly healthy. You look at consumption, it's holding up well. You look at business results, even though we're likely going to have a very brief, modest period here of earnings contraction. Overall, corporations are navigating this period very well. And so we still see a lot of positivity in the overall economy and in corporate results, which, of course, we're very interested in as equity investors. And so it seems to us like the economy is actually weathering this period fairly well. Now, even if some of the recent developments tied to funding and banking and so forth do push us a little bit closer to recession, it's really hard to see us going down a path of a steep recession. We've kind of tended to think of things in three possible scenarios. No recession at all, which I think is a distinct possibility. And if we get that, certainly that's an upside surprise given how intense these recession worries have been. Maybe a mild recession, but as I said, that expectation we would say is probably pretty well baked into the market already. And I think investors probably start looking past that pretty quickly if that's the eventual outcome. It's the big bad recession, the financial crisis, the real estate implosion. Usually to get a big recession, something needs to go really wrong in the economy. It's not apparent to us at all what that might be, but certainly it's not an impossibility. But I think that's maybe the scenario that markets aren't priced for right now. But in those other scenarios that seem like much higher probabilities, either no recession or a mild one, our forecast this year, which is a positive forecast for equities, really doesn't hinge too much on getting a recession or not. I think equities can do well in either of those scenarios.
I think it's a good point that, the way you describe it is the markets are going to be forward-looking, and if everybody's already talking about a mild recession, then if there is a mild recession, well, it's already kind of priced in. When you think about the more big bad recession that is always a possibility, how do you deal with that when you're thinking about your portfolios? And you have to always be mindful of it, because it can come really quickly in the case of COVID or something like that, or it can come, it can be a protracted recession due to long, slow difficulties or geopolitical events or whatever it is. Does the team and your portfolio managers and the way you think about the holdings in the portfolio change because of the likelihood that that might appear, more likely to appear than not? Or is that just something that you always have to be aware of, but it really doesn't change the makeup of a portfolio or the type of stocks that you invest in?
Yeah, more the latter, because I think the nature of a big, bad, and ugly event like that, for equities, I think it has to have some characteristics. One, it does have to be bad and big, meaning that it has to have some real economic magnitude to it. It can't be a small, isolated issue that affects an isolated part of the economy or isolated part of the world. If you're thinking about global economic activity, the small issues just aren't big enough to lead you down a very bad economic path. And so it has to have some real size, the ability to knock literally probably trillions of dollars off the global economy to really have a big effect on equities, or at least be something worth taking some extreme portfolio action in anticipation of. It also has to be surprising. As I mentioned, we think equities are efficient. And so when everybody's worried about even a big topic for a very long time, as they have been worried about, geopolitics and worried about, monetary policy and inflation, those concerns have been on investors' minds for years at this point. And I think we're some of the key contributors to all the volatility that we saw in 2022. And so there's not a lot of surprise power, I would argue, left in those specific issues. But that's not to say that there aren't things that couldn't catch investors and economists and so forth off guard. And so it has to have that combination of being something that the market isn't already focused on, and it needs to be big enough to actually do some damage. And you can come up with all different types of things that could do that are very low probability events, but would be surprising and would have the magnitude to cause problems. And so I don't think from a portfolio management standpoint you can or should react to every little low probability event that could be highly problematic. All that said, if we did start to feel like the risks were rising, take an issue like regulatory risk. If in the wake of these banking problems we get a big wave of regulation and it's got some unintended consequences that could cause an actual financial crisis, well, if we started to get an increasing sense that that was a high likelihood, we would want to do something in portfolios about that. Or, if we thought something else was going to happen. I mentioned, the Fed gets too much credit for most everything these days, but that doesn't mean that they can't cause problems. There are plenty of instances of monetary policy errors, over-tightening, and so forth, leading to bad economic outcomes. And so if the Fed all of a sudden seemed like it was going off the rails, and just regardless of what's going on in banking or what's going on with inflation moderating here or in the economy overall, they decided they're just going to hike us into oblivion, well, then we probably would want to take some portfolio action in response to that. But most of the time, these are things that you need to monitor, but you really don't want to do much about them in a portfolio sense until they become much higher probabilities in our minds, and probably something that maybe we think we're seeing that the rest of the market isn't seeing yet.
And right now, almost feels... Sorry, you go, Aaron.
I was just going to say, right now, I can say that we're not seeing anything that has us overly worried. I could come up with a bunch of things that, if they really went, squirrely, could cause a lot of problems. But all of those would be low probability, outcomes. Not something that we're particularly concerned about right now.
And you'll always be able to come up with those examples, even when things feel pretty good out there. And so it's kind of it's one of those things that you can. I always say you can always create a narrative of negativity if you really have to, and it's not necessarily the right way to be minded. But you've got a lot of your clients are the same types of clients that NZ funds have. So the mum and dad investors who are investing their sort of long-term retirement savings. The way that I see it when we see some of the behavior out there in markets and the negativity, and is actually this is the time where you can be a bit more, if you're long-term focused, a little bit more opportunistic of continuing with your investment strategy, continuing with your savings and tranching into markets, because we're buying shares at this point in the cycle a whole lot cheaper than we were 2 years ago. And 2 years ago, people really wanted to buy stocks because their taxi driver told them to.
Absolutely. I just love a quote from Sir John Templeton. I'm sure we all know who that is, one of the most famous investors of all time. But the way he described how investor sentiment progresses over the course of the market was to say that bull markets are born on pessimism, they grow on skepticism, they mature on optimism, and they die in euphoria. And I think in that sense, where we are right now in that sentiment cycle is exactly where new bull markets usually begin. Usually they begin before you've got any type of all clear signal. They begin with a lot of worry about a lot of different things, extreme amounts of pessimism, and then gradually, even though there's still economic problems like we're seeing today, it's not as if the world is perfectly pristine from a macroeconomic standpoint. But that's the wall of worry that bull markets usually climb, and I would say that we're most likely in the early stages of that. So I would agree with that sentiment entirely. As I think it's Warren Buffett likes to say, not to quote too many investors here, but be greedy when others are fearful and be fearful when others are greedy. And certainly I see a lot of fear out there today, which says to me, I don't think it's ever pays to be too greedy, but I think it does make a strong case that this is exactly the type of time when you want to think about investing for the long term.
Yeah, our ears always prick up when you hear from CNBCs or whatever this market is uninvestable, and at that point you know that this is the perfect time to start investing. And we probably heard that from a few quarters, but yeah, it seems like what we always say is stick to your plan and don't let the sort of the short-term noise affect what you're trying to achieve in the long term. Aaron, I know you at Fisher are, at the moment at least, quite technology focused. One thing I wanted to ask you before you went, and I know it's a bit cheeky because we said we'd talk about banks, but there is a lot of talk about AI and ChatGPT, and I won't pretend I know much about it, because no one really knows much about it except for the people, I guess, coding it. But when there is Fish has also been around for quite some time, and so this was probably the exact conversation we're having when the internet was coming up to fruition. It probably happened again when I think maybe 10, 15 years ago, when SaaS companies were starting to be a major disruptor in the technology space. When new technologies come along like AI, what do you do as investors? Do you put resource towards looking at it and monitoring it? When do you start thinking about it as an opportunistic way to invest, because maybe the companies that aren't really even generating revenue, a lot of the companies at the moment like ChatGPT are already tied up in a Microsoft anyway. Just curious as to how you're looking at that sector at the moment, given it's such an emerging sort of unknown at the moment, but is obviously going to be a big part of our lives somehow, but we just perhaps don't really know how yet.
Well, first off, we are big believers, not only from an investment standpoint. You're right to say that, in our portfolios, we do like technology, at least for the time being. We're not permanently married to having an overweight to technology, although we do think it's compelling right now. But I think always, technology is an important component of lots of different industries. Even banking, is going to have a huge technology component to it. AI, is going to play a big role in lots of different industries eventually. So whether it's recent developments in AI, whether it's Moore's Law that's been going on for a long time, I mean, the benefits of technology advancing and just all the benefits that bestows on the economy and corporations, I think that is just a persistent trend over time. Now, I think what stands out about AI to me is how this just seems to be a bit of a step function in terms of some of the potential benefits, but also some of the potential disruptions. I think you're exactly right to say that, thinking about AI in terms of what AI company do I want to go out and buy? I don't know that that's necessarily the right approach. I mean, I think ultimately the beneficiaries, or at least the prime users of AI, are going to be probably, some of the biggest companies with scale. I mean, if you are Alphabet right now, you are all hands on deck trying to make sure that you're a leader in AI. So is Microsoft, inevitably. So will Apple be. All the big companies out there are going to spend whatever resources it takes to mean they're successful there, which probably means some opportunities for smaller companies like you saw with ChatGPT and Microsoft investing there and so forth. But it's going to be a fierce competition, as it is in lots of industries. I mean, I think one thing that some of the big innovation trends over the last several years have shown is that eventually competition gets to be incredibly fierce. I mean, you think about EVs today, you think about streaming services over the last few years. If you're a pure play streaming company and all of a sudden you're competing not just with Netflix, but you're competing with Apple and Amazon and Disney and every other company out there that's engaged in streaming services now, well, that competition gets fierce. It pushes your margins down. It requires massive amounts of investment. And so I don't know that going out and searching for the pure play AI company is the way to play the AI innovation. I think probably some of the biggest beneficiaries there are going to be some of the big mega cap tech companies that are going to do whatever it takes to make sure that they're successful with those technologies. But I think AI, in contrast to some of the other kind of hot trends that have developed over the years, I think AI is very, very real. I mean, it's not the nanotechnology, that got very popular for a while and then is still around, but kind of faded in terms of investment theme, or 3D printing or those types of things, which is still very important and around, but got very popular for a while and then that faded. I think AI is here to stay. I think it is going to have some real impacts, but exactly as you mentioned, I don't think we know exactly what those impacts are going to be. I think there are going to be some winners and undoubtedly some losers. You've already seen some companies, one specific company whose name I won't mention, but a U.S. company that's involved in online education services, just in their very recent earnings announcement, badly missed expectations, and their explanation for it was that AI is now, more students are turning to AI for help with their homework and studying and so forth versus relying on their services. And so undoubtedly there are going to be huge efficiency gains that come from incorporating more AI. And there are also going to be losses. There are going to be companies that suffer as a result of that. And so I do think from an investment standpoint, having an understanding of how AI is likely to impact different businesses is critical at this point. But I expect it'll be adopted in big ways in lots of different industries. And it'll also come with lots of political worry about it. Already, for instance, here in the U.S., you're seeing strikes for writers in Hollywood. And one of their concerns has been that production companies are going to rely more on AI to write scripts and jokes and all the things that they do, and so they want some limits on all of that. So I think you're already seeing some worry about that. To the extent AI starts to displace too many people, you're going to see some political response to it. And so I think the future of AI is absolutely going to be pushing in mostly a positive way of huge efficiency gains, doing a lot more with less. I know that people tend to worry, well, what does that mean for employment? Isn't that going to put a lot of people, out of jobs and so forth? Certainly in some industries it could, but these are very normal things. I mean, you've seen the same thing taking place in agriculture for decades. I mean, we produce a lot more agriculture with a lot fewer farmers, and that's been a steady progression over many decades. Same thing in manufacturing. We do here in the U.S. as much manufacturing as ever, but we do with a lot fewer manufacturing employees. This is just the natural trend of technology advancement. So I do think AI is here to stay. I do think it's going to be very powerful. I do think there are going to be a lot of benefits that get bestowed from it, including disinflationary forces. I mean, I think technological advancements like these, by their nature, tend to be disinflationary. So to the extent everybody's worried about really persistent long-term inflation, I think one of the most compelling disinflationary forces out there is technological advancement, and AI is a great example of that. But I think there are also going to be some industries that really get disrupted by it, especially if they don't adapt. But just to put a bow on all of that, I'll say if there are gains to be made from AI, which, as I've said, I really think there are, the corporate world is undoubtedly going to uncover the best way to do that. And so putting on my investment hat for a moment, thinking about, well, what's the best way to play it? I think public equities, and investing in companies that are going to figure out ways to make their companies more efficient, to get the margins higher, to do all the things that come along with greater AI adoption. I think investing is one of the key ways to take advantage of something like that, even if it's not necessarily investing directly in an AI company. I think banks will benefit. I think technology companies will benefit. I think manufacturers will benefit. There are lots of gains to be had across the corporate landscape from the AI trend that is, I think at this point, fairly inevitable.
If I could just sort of grab that whole quote that you just said about AI, and I'll just copy it, because I think that's the perfect explanation as an equity investor of how we should look at it. Because I don't want to go and buy a basket of AI companies. I don't know what they do or how they do it, but I do know that AI is going to be a big part of all companies, and it's going to really increase productivity and efficiency and profitability, and that's something that's good for the economy and good for companies, and we're already invested in all those companies because there's people working away in all of them trying to think about those sorts of issues. So really appreciate your thoughts, specifically when we're here to talk about banks and now we're talking about AI. Aaron, I've kept you for an hour now, and I should let you go because it's now your evening, and you've probably got dinner to go and enjoy, or I'm not quite sure what the time it is in California. Maybe it's a little bit earlier than that. But look, I really appreciate your time and your thoughts, and for safeguarding a portion of NZ Fund's clients' money and investing it in such a long-term way that makes it a real joy to watch and succeed and compound over time. So really appreciate your time and all the efforts from you and your team for doing that on behalf of us.
Yeah, well, thank you very much. It's a great honor and pleasure of ours to work for you and NZ Funds and your clients, and so something that we take a lot of pride in. So thank you for having me today, and thank you for giving us the opportunity to do that.
Excellent. Well, next time I don't quite know what we'll be talking about. Maybe it will be, we won't even need to talk. It will just be our AI
That's right.
puppets speaking for us. But until then, have a great rest of your day, and look forward to speaking soon. Thanks, Aaron.
Yeah, thanks very much.